Have you ever risked $100 on a stock just to make $20? If you ever invested like that, it's not because you're bad at investing. It's because most people are taught to play the wrong game. In this video, I'll show you the one rule that changes how you think about risk and reward, why it flips every investing decision you make, and how regular investors use it to stop risking a lot just to make a little. But first, here's the scary part. If you keep investing the way you do now, you don't usually lose big. Instead, you just slowly cancel yourself out. One small win here, one quiet loss there, until years go by and nothing really changes. Your account is exactly where you started years ago. Most people think that they have an investing problem, but after looking at my own disastrous portfolio from a decade ago, I realized I actually have a logic problem. Like many people, I was playing a game that was mathematically impossible to win. I remember staring at my screen, admiring at a 20% gain on Facebook after selling it at the top of its 52-week range. I felt like a genius. I felt like I'd beaten the market. But then, I did something painful. I zoomed out and I saw a sea of red. I saw the zombie stocks I've been holding on for 18 months, refusing to sell because I told myself, it's not a loss if I don't sell. While I was waiting for these zombies to crawl back to even, inflation was eating 3% of my money every year, and the market was sprinting past me. My wins were tiny, capped gains, while my losses were infinite time sinks. I was risking 100% of my capital just to make a measly 20%. The math was broken. I wasn't an investor, I was just a bad gambler. And here's the part that kept me up at night once I realized it. Every dollar tied up in a zombie stock wasn't just sitting still, it was a soldier I had taken off the battlefield. I wasn't just losing the 3% to inflation, I was losing the 10%, 20%, or 100% gains I could have had if that money was sitting in something else instead. I was paying a patience tax that I never agreed to. And breaking even is actually the most expensive way to invest because you're paying with the one thing you can never get back: time. It wasn't until a few years ago that I finally understood why I wasn't making money. I wasn't following the number one rule that the elite investors were following. While I was risking $5 to make $1, the elites like Kyle Bass and Paul Tudor Jones were doing the exact opposite. Jones would risk $1 to make $5 in what he calls his 5-to-1 rule. I had it all backwards. This rule is known as asymmetric risk/reward. Put simply, you risk a little to make a lot. Most of us are brainwashed to fail by the age of 10 because in school, 90% is an A, but in the stock market, chasing a high GPA is a fast track to being broke. Remember what school exams were like back in the day? 50 questions, 2 points each. The more we got right, the better we'll do, and the less chance our mom will beat us with her left slipper. No? Just me? Before I knew this rule, I was trying to study every stock like it was a final exam. At the time, I was a full-time student with a part-time job, yet I was spending every spare second between classes and on my shifts refreshing stock prices 500 times a day just to see if my smart plays were hitting that 52-week high. I thought if I could be right 80% of the time, I'd be making good money. I was terrified of being wrong more times than I was right, and this thinking set me up for failure. I remember passing on high potential stocks because they had a 20% chance of succeeding. Instead, I chose a smarter option for a 10% gain that eventually stalled. My account wasn't going up much, so I picked up an investing book and came across this rule of asymmetric risk/reward. I finally realized I've been doing this the wrong way. That was my aha moment. I realized that the market doesn't grade you on how many questions you get right. Instead, it's like a test in which 48 questions are worth 1 point, but the other 2 questions are worth 1,000 points. I was getting an A in effort, but a D in actual wealth. This flips your investing because you stop obsessing over your win rate. You stop caring about being right more times than not. Instead, you start obsessing over finding that one bonus question, that one player that cancels out every single loss you've ever had. You realize you can fail 48 times, but if you get those 2 big questions right, you don't just pass the test. You'll become the top of your class. Now, let's be clear here. I'm not suggesting that you run out to buy 1,000 random AI startup stocks and hope for the best. You'll probably bankrupt yourself that way. Let's look at a much better strategy. The biggest lie in finance is that the best opportunities are reserved for the Wall Street elites. The truth is, you don't need superior knowledge in stocks or a supercomputer, but you do need the right mindset, which we'll talk about. Although you can go through years of schooling, to learn risk-reward analysis, valuation, and other Wall Street jargon, you don't have to. Instead, you just need to stomach more than the average person. Most people look at a market crash, see a minus 20% dip, and panic sell. They see winter coming and assume the world is ending and we'll never see spring again. But for the asymmetric investors like us, that winter time is the greatest gift of our lives. When a crowd of panicked investors drags a great stock into the gutter, your downside is basically limited because the price is already in the dirt. But your upside? That's where the 5-to-1 lives when the seasons inevitably change to spring. This isn't about gambling on penny stocks or getting lucky. It's about recognizing what most people don't. Market climates are seasonal. Do you remember that massive COVID crash in 2020 when the world looked like it was going to end? Remember what happened right after? Yep, that's right. Record highs, all in a matter of months. From that low point to today, the S&P 500 market index, which tracks the top 500 US companies, went up over 170%. 170%. To make things even better, you might even have a slight advantage that the pros don't have. Quarterly reports and client pressure often limit what they can do. Even though the ideal strategy is to not sell during a crash, they will probably face pressure from their clients to sell and cut the loss. But you have the easy advantage. You can afford to wait for the seasons to change. For the guy running a $10 million hedge fund, if the market drops 20%, his phone starts ringing off the hook. His investors are screaming. If he doesn't sell to protect their capital, he loses his job, his bonus, and his reputation. He is forced to be a coward and do things that he probably knows better than to do. But you can sit in your bedroom, eat a slice of pizza, and watch the world go up in flames without a single person calling to fire you. Your lack of professional pressure is actually your greatest financial weapon. You have the freedom to be greedy and take advantage of the chaos while the experts are forced to be fearful. So, is this asymmetric risk-reward strategy only for pros? No, in fact, it's much easier for you. You don't have to answer to someone or something else. You just have to answer to you. And if you get your mindset right, you can capture a 170% rebound that most people miss. Remember, asymmetric bets happen when the world is in chaos and everyone else is running for the exits. But investing in undervalued stocks when things look the darkest, you're basically risking $1 of temporary paper loss to make $5 of permanent wealth. Everything you just learned only works if your money is in the right place when the market turns. Most people understand the rule, then blow it by holding on to the wrong things at the wrong time. Ray Dalio built a portfolio that solved this. His portfolio doesn't care whether the market crashes or booms. In this next video, I'll show you exactly what is in this portfolio, so the next time panic hits, you're prepared and won't be caught off guard. 430 people are subscribed right now because they want to improve their financial health. If you would like to do the same, be sure to subscribe so you don't miss my future videos.